Hello everyone, welcome to our proactive year-end tax planning ideas for 2020 workshop. One of our main goals as comprehensive financial professionals is to help our clients recognize tax reduction opportunities both within their investment portfolios and in their overall financial planning strategies. Staying current on the ever-changing tax environment is a key component to help our clients benefit from potential tax reduction strategies. The objective of this workshop is to share strategies that could be effective if considered and implemented before year end. Please note that this workshop is not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations as the federal income tax rules. Make sure you check with your tax preparer to see what tax rates and rules apply to your state. Our main theme for this workshop is that a proactive approach to your tax planning instead of a reactive approach could produce better results. Today's agenda is straightforward. We will review year-end tax planning. While doing so, we will discuss some tax planning ideas and strategies you can consider. We believe in educating our clients on their choices. Our goal today is to give an overview of tax planning so that when you look at your situation, you have a strong foundation of information. Please remember each taxpayer's situation should be looked at individually. The good news is we are available to talk with you about the specifics of your situation. Before I get to the presentation, I would like to take a minute to remind you to stay healthy because your health is our highest priority. We are still experiencing challenging and unprecedented times, and as we like to share, your first wealth is health. I find it is always important to review that there are 5 key areas of financial planning. These areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is about tax planning, which can also affect estate planning. As a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Tax planning for 2020 became a little more complicated because of the Secure Act, which was signed into law in December of 2019. And the 2020 CARES Act added some new laws and rules for taxpayers as well. Also, with this being a presidential election year, it is helpful to consider some of the tax proposals that are being discussed so that you can plan in an informed way. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. This workshop is about tax planning, not tax preparation. It is about hearing some proactive ideas that you can consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." For 2020, there are still 7 tax rates. These rates are 10, 12, 22, 24, 32, 35, and 37%. Under current law, this 7-rate structure, which was created by the Tax Cuts and Jobs Act, is scheduled to automatically phase out in January 1 of 2026. Here are the current tax rates for married filing jointly and single filers. Married filing jointly has lower rates on many amounts. For planning purposes, something you need to remember is that even if no changes are made to tax rates, in 2026, the law says we go back to the older, higher rates. Tax brackets are important, and current tax laws call for a sunset in 2026, which means we go back to the older, higher rates automatically in 2026. When thinking about your plan, please remember this. As this arrow shows, for some people, that means income that will be taxed at 24% today could be taxed in 2026 at 33%, a much higher rate. For 2020, the standard deduction amounts are $12,400 for individuals, $24,800 for married couples filing jointly and surviving spouses, $12,400 for married couples filing separately, and $18,650 for heads of household. So, how should you view itemized deductions if you did not take the standard deduction? The old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deductions, the new rule is to time or plan deductions. Two of the more widespread deductions that taxpayers look at if they choose to itemize and not use the standard deductions are mortgage interest and state and local taxes, also known as SALT. Under the new rules, for mortgages taken out after October 13, 1987 and before December 16, 2017, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first $750,000 or $375,000 married filing separately on homes purchased after December 15, 2017. For those of you with mortgages, please check with your tax preparer for how much of a deduction you could take. The Tax Cut and Jobs Act also limited state and local income, sales, and real and personal property taxes, SALT, to a maximum deduction of $10,000. One strategy for those taxpayers who like to give to charities is to consider bunching charitable contributions. Here is an illustration of how that could work. If you were married filing jointly and had $10,000 of state and local taxes, which includes property taxes, and $5,000 of mortgage interest, and give $10,000 to charity and no other itemized deductions, then you would have itemized deductions of $25,000. The standard deduction for you is $24,400, so you would gain $600 by itemizing. In a 35% federal tax bracket, that has an after-tax savings value of $210 to you. If you were to do that for 3 years, it would be worth $630 to you. An alternative strategy is to gift $30,000 in 1 year and then use the standard deduction in years 2 and 3. That would bring your deductions to $45,000 in year 1 and save you $7,210 over the standard deduction in year 1 at a 35% tax rate. By doing this, you would lose the additional $210 in tax savings from years 2 and 3 that you received in the other scenario. But your total tax savings is $7,210 versus $610, which is a difference of $6,580. Now you might be thinking $30,000 is a lot to give in the first year. So let's look at how a donor advised fund or DAF works. If you place the $30,000 in the donor advised fund, you get the deduction immediately, and then you can give to the charitable contribution as you see fit when you see fit. If you have any questions on this or want to discuss this strategy, please give us a call. Something that the CARES Act offered that is new for 2020 is a new charitable deduction available to taxpayers who do not itemize their deductions in 2020. This new benefit, known as a universal deduction, allows for an above-the-line or before you calculate your taxable income charitable deduction of up to $300 per individual, $600 for married filing jointly. To qualify, the charitable gift must be cash or cash equivalent made to a qualified charity, a 501c3. This contribution must be made on or before December 31st, 2020. As this draft 1040 from the IRS website shows, this deduction can be taken before you calculate your adjusted gross income. If you are itemizing or did last year and like to give to charity, please consider using this deduction and remind your tax preparer that you did. Qualified charitable distributions, QCDs, are a strategy for retirement savers. As part of the Secure Act, required minimum distributions, or RMDs, were changed to start at age 72 instead of 70 and a half. Also, the CARES Act allowed you to skip or not take your RMD for 2020. Qualified charitable distributions are a tax law provision that allows retirement savers over age 70 and a half to directly distribute up to $100,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all of your required minimum distribution, or RMD, for a QCD, qualified charitable distribution. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested in evaluating your situation. In 2020, long-term capital gains still receive a tax break. Here are the three tax rates: 0%, 15%, and 20%. One planning item that many taxpayers think about is tax gains and loss harvesting. Harvesting capital losses is a strategy that has a taxpayer selling assets that are at a loss to offset capital gains. This reduces or eliminates tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax saved. However, sometimes it could only provide a timing benefit. This is a tax deferral strategy that could be valuable. Capital losses are highly tax effective if they can be used to offset income taxed at higher rates. A key fact to remember is you can use up to $3,000 in capital loss above capital gains to offset ordinary income. Also, as a warning, watch out for the wash sale rule. This rule prevents taxpayers from repurchasing a substantially similar security within 30 days of selling at a loss. If you have any questions on loss or gain harvesting, call us or your tax professional. Capital gains harvesting means taking capital gains in the current year. On the surface, it might appear that taxpayers should always harvest gains because of favorable rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for a tax purpose, although the tax is paid at a lower rate, it is paid sooner. In a few minutes, we're going to talk about some tax policy proposals. But this is timely, so let's look at one of former Vice President Joe Biden's tax proposals that is about capital gains rates. The proposal is to eliminate the preferential rate for long-term capital gains and qualified dividends on income over $1 million. This is a significant proposal and a fundamental shift, because capital gains rates have never been eliminated for any taxpayers. This proposal is for those affected, basically an increase from 20% to 39.6%. If it looks like it could be enacted, then at today's lower rates, many people could sell assets to avoid the higher rate. Let's look at how this works. Old 2017 rules had three rates for long-term capital gains and qualified dividends. 2020 still has three rates for long-term capital gains and qualified dividends. 2022 could bring four rates for long-term capital gains and qualified dividends. Therefore, we need to continue to follow the tax law changes and proposals. Remember to review your year-end retirement contribution planning. Here are some contribution plan maximums that could be applicable if you are participating in one of these plans. Another critical area to review before you're in, because of the Secure Act, is what we refer to as overall family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket, rather than you take it in yours. However, if your beneficiaries are in higher tax bracket, then it might make sense to take distributions in your tax bracket before death, and then convert these accounts in Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years, but can grow tax-free. An annual step to consider is to review your marginal tax rate and your beneficiaries' marginal tax rates every year. Some benefits from Roth IRA conversions include: they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs at age 72, or at any time for that matter, unless they're inherited. Roth IRAs allow tax-free withdrawals for beneficiaries. Qualified tuition plans, also named 529 plans, are a great way to tax efficiently plan the financial burden of paying tuition for children or grandchildren. Originally, earnings in a 529 plan could be withdrawn tax-free only when used for qualified higher education at colleges, universities, vocational schools, or other post-secondary schools. However, the rules changed so now 529 plans can also be used to pay for tuition at an elementary or secondary public, private, or religious school, up to $10,000 per year. Unlike IRAs, there are no annual contribution limits for 529 plans. Instead, there are maximum aggregate limits, which vary by plan. Under federal law, 529 plan balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. 529 plan limits vary by state, ranging from $235,000 all the way up to $529,000. Some states even offer a state tax credit or deduction up to a certain amount. Contributions to a 529 plan are considered completed gifts for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above $15,000 must be reported on IRS Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption amount, which is currently $11.58 million. There's also an option to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread evenly over a 5-year period. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy to spend down assets. If you want to explore using or setting up a 529 plan, it can be confusing, so call us and we will be happy to assist you. Let's talk about annual gifting now. You may gift up to $15,000 tax-free to each donee in 2020. These annual exclusion gifts do not reduce your lifetime gift tax exemptions. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. You can also help someone with medical or education expenses without incurring any gift taxes. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. You can find the detailed qualifications in IRS Publications 950, and the instructions for IRS Form 709 are at www.irs.gov. A wealth transfer planning item to think about is the exemption amounts for gift, estate, and generation skipping taxes for 2020. It's $11.58 million or $23.16 million for married couples. Any amount over that is subject to 40% federal taxes. This high amount provides high net worth individuals a significant planning window to make gifts and set up irrevocable trust. As a reminder, as of now, in 2026, the estate tax exclusion will return to $5.49 million, which is $5 million adjusted for inflation. On November 26, 2019, the Treasury Department and the IRS issued final regulations under IR-2019-189, which confirms that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted when Tax Cut Jobs Act sunsets in January 1st, 2026. If you have a large estate, please call us to discuss this. While the election is in November, Democratic Party nominee Joe Biden has released some possible tax law changes he would like to make if he wins the presidency. While these would be future changes and must be approved by Congress, to help you think about planning your future strategies, here are some of the proposed changes to be aware of. Increase corporate tax rates from 21% to 28%. Increase the marginal tax rate for top earners from 37% to 39.6%. Raise the capital gains tax on filers with incomes above $1 million to 39.6%. Limit itemized deductions. Biden's tax plan includes a cap on itemized deductions of 28%. This means for each dollar of itemized tax deductions, including charitable contributions, a taxpayer or couple filing jointly would only receive a maximum benefit of 28 cents on that dollar, even if a filer is paying a higher marginal rate. Phase out small business income deductions for those earnings over $400,000. Eliminate step-up in basis. A step-up in basis refers to the cost basis of assets or property transferable to an heir upon death. If, as an example, an individual purchased a home for $300,000 but it is now worth $600,000 at the time of death. Today, their heir would pay capital gains on anything over that $600,000 if the home were ever sold. If Biden's tax proposal were to become law, heirs would not inherit a stepped-up cost basis and have to pay taxes on anything over the $300,000 initial cost or basis. Also, reduce estate tax exemptions to $3.5 million immediately. This means estates over that would be taxed at the 40% estate tax rate. Obviously, this is all a proposal, but it could be helpful information as you plan for future tax years, depending upon the election outcome. In summary, here are some items that you should review prior to tax time. What is your tax bracket? Do you take standard or itemized deductions for timing purposes? Capital gain and loss harvesting, retirement planning contributions, education planning opportunities, charitable gifting planning, and estate tax planning opportunities. It's also helpful to think about tax planning for any major financial or life events next year or in the future, as well as tax planning for any other personal, situational concerns. Our tax report for year-end tax planning is available, and as we said when we started, a proactive approach to your tax planning instead of a reactive approach could produce better results. If you know anyone who could benefit from our report or this workshop, please pass it on or let us know. We enjoy helping others and always consider an introduction to others to be the highest compliment we could receive. Thank you for your time today. Remember, your health and well-being is our highest priority. Our goal is to help you, and we appreciate the opportunity to assist you with your financial needs. If you have any questions or need further assistance, please don't hesitate to contact us.